Hi guys, this is Dan from the Investment ABC, and in this video I'm going to explain what the yield curve is and why it is important to pay attention to it. The yield curve shows you visually how much yield you get for US government bonds with different maturities just in one chart. The left diagram here is the yield curve. You can see the bond duration at the bottom of the chart. We have 3 months, 2 years, 5 years, 7 years, 10 years, 20 years, and 30-year bonds. On the left side, you can see how much yield you get for each of these bonds. When you plot it in a chart, you have the yield curve. You can see how this yield curve is changing and how the shape of the yield curve is looking. The right diagram is showing the chart of the S&P 500 from the year 2000 to the year 2018, and when we scroll here through time, we can see how the yield curve on the left side is changing. See, the yield curve is changing with each interest rate cut or interest rate hike. So it just shows how the Federal Reserve can influence the yield curve. And yeah, normally the yield curve has a positive slope. That means that short-term bonds yield less than long-term bonds. For example, here like a 3 months bond is yielding less, like here 1 point something, compared to a 10-year treasury bonds, which yields here more than 3%. And this makes typically sense, because why would you tie your money for a long time or longer time and yield less? Doesn't make sense. But there are certain times, especially before recessions or major bear markets, that the yield curve inverted and had a negative slope. Like, for example, you can see it here during the dot-com bubble. Here we can see that while the stock market is rising, the Federal Reserve is hiking the interest rates. They're hiking, and at some point right before the crisis, like here, we can see that, for example, 2 years or 3 months bonds are yielding more than 10-year government bonds, and which doesn't make normally sense, because you're getting less for your money compared to someone who when you tie your money for a longer time frame, compared to someone who gets more for when he is tying his money for a shorter time frame. Doesn't make really sense. But the question is, why is this happening, and why are investors willing to get less yield when they tie their money for a longer time frame? Yeah, the reason is that, in my eyes, they know more than other investors, or they can feel either they're very good at timing the market, or they have inside information and know when to sell. So if you are an investor and you achieve to say you bought your stocks or your assets, you bought it here, and you ride the wave up to here, and you have a substantial amount of profits, and you take your profits here at the peak of the market, and you switch from stocks into bonds, yeah, you can see that even here that you can get you can still get like a good return, like a still high yield, even if it is less than 3 months or 2 years government bonds. You can sell your stocks and you can go into this long-term 10-year government bonds, because you're expecting the stock market to crash, and you just like, it's a safe haven trade. So you sit at the government bonds and you have a yield here of what was it? Yeah, you have a yield here at say 5.2%, and you just like park your money there, and while the assets fall, you know that the Federal Reserve has to slash the interest rates, and you just ride the wave. You collect your 5 point something percent each year, and just wait and see. While you wait, and while the Federal Reserve is slashing the interest rates, the 10-year, for example, the 10-year Treasury yield at the bottom is still, it's yielding just something like maybe around 3.94%. It is way less than your 5 point something percent when you switched into the bonds, and also you don't get just the interest payment. On top of it, the bond prices they increased a lot, because when yields decreased, bond prices increased. Now what you can do is, while the stock market is at the bottom and bond prices are high, you sell your bonds. You made a good gain on your bonds, and go back into the stock market and ride the wave up again. And yeah, that's how smart investors or someone in the know makes the money. And I think that these bond investors, they know more than other investors, because they are rich, they are very rich people, and they have deep connections with probably also the people who are sitting at the Federal Reserve. Just think about it. The Federal Reserve, they have friends, they have families, they talk with their friends, with their families, and these friends and families, they're talking with their friends and families. And these rich 1%, they know when the Federal Reserve is about to pull the plug on the markets, and obviously they the first ones run to the exits. So if you follow the smart money, you can still time the markets and know, okay, when the party is ending. So this is why keeping an eye on the yield curve is so important, and understanding the yield curve is so important. And I hope with my video I could explain to you why you really have to pay attention to the yield curve, and especially when it is inverting. Right now we are very close to the inversion. I think this is till the 21st of December. And we can see that 2 years and 10 years treasuries are not, the spread is not too far apart from each other. So at some point, maybe in the next few months, complete inversion is happening, and we should be very, very careful about that. Or we can also start that through the last 1.5 months since October, the stock markets crashed a lot, and maybe, or what I think is, it's just the beginning of the major crash. We can see that especially these times are very extreme times. 2017 was the best year for all assets, while 2018 was the worst year for all these assets. Clearly, over time, because the Federal Reserve kept the interest rates so low for so long, the assets are really, really overvalued. There is so much money and speculation. So much money was flooding into these assets. because money was cheap and money was free available. And now when the credit and money is tightening and liquidity is getting less and less, I think the crash is really going to be really strong. So prepare for it. And yeah, that's it. I hope you liked my video, and press the like button and subscribe, and I hope to see you soon. Thanks guys. Bye.